Welcome back. The big story of the day here in Canada is the inflation print that was released just a short time ago at 8:30 a.m. Eastern Time, about 47 minutes ago. Let's bring in Jimmy Jean. He's Vice President and Chief Economist and Strategist at Desjardins for his take. And one of the big questions, Jimmy, thanks for joining us, first of all. One of the big questions here is inflation came in much softer than expected on a headline basis, not so much on a core basis, but on a headline basis. Does that make it easier for the Bank of Canada, which is facing this dilemma? Does it raise rates to control inflation? It seems that that is less of a priority coming out of this print. Or does it now have more room to cut rates to support a slowing Canadian economy? What's your take?
Well, I think in the big picture, the Bank of Canada still does have room to cut rates. The big question is whether it will do so tomorrow. And you look at this report, yes, indeed, you had less upward pressure coming from the reapplication of the GST, the first full month where we've seen the GST reintroduced. So we were expecting to see more strength based on that. But you do see some weakness coming in travel categories, airfares, and we have to be careful. It might be the impact from what's going on with the U.S., but we've seen a lot of volatility in those categories in the past, so they could easily pop back. So the Bank of Canada has to be careful here. But what's interesting is that I think the first reflection of the current tensions is really what we're seeing playing via gasoline prices. And we know that April is going to be coming in even weaker on that front. So that's one thing. We're also going to have the carbon tax removal effect for the consumers that will also be a drag on CPI. So if you look at those alone, you could say, well, the Bank of Canada doesn't really have to worry here. But on the flip side, you still have, as you mentioned, you look at core inflation ex shelter, and it's still running at that 3.5%. So that's really hot, and that's one indicator the Bank of Canada looks at pretty attentively. And very importantly, it's what's ahead in the form of retaliatory tariffs. Obviously, that's been sort of in flux, but there's no doubt that those tariffs will be reflected in prices as we go forward, and the Bank of Canada wants to preserve its credibility in terms of what it's seeing on that front, and also what it's seeing on inflation expectations.
Yeah, that was my next question. These were March numbers, of course, before U.S. tariffs were imposed and before Canada announced its retaliatory tariffs. Now, people knew the tariffs were coming, certainly in March, but they had not yet arrived. So how likely is it that the tariff situation, Canada and the U.S., will boost prices in April, May, June, and through the summer?
Yeah, well, we do have the tariffs, setting inflation on an upward trajectory throughout the year. Not necessarily the case that they will all have an impact in the next few months. That remains to be seen. Sometimes, and in some certain categories, it can take a number of months before these shocks filter through to the end consumer. But there's no doubt that if things stand, there will be some impact. Now, there's been some exemptions, as we know, things have been, the configuration, the design of those tariffs have been shifting and continues to shift. There's still maybe modification upcoming for auto parts. So all this, how it all plays out, and how the eventual negotiations between President Trump and the next prime minister, how that goes will also matter for inflation. So the Bank of Canada has, it's a very muddled picture right now, but it doesn't want to commit the mistake of 2022 of saying this will just pass, because you're seeing inflation expectations both in the U.S. and Canada, shoot higher, and this is something the Bank of Canada takes seriously. So that's why we lean on a pause still tomorrow. But in the grand scheme of things, if we do see a significant shock to the global economy, to the U.S. economy in particular, that's what we're really concerned about right now. Canada will be in for the ride, and that will be disinflationary in the end. So we think the Bank of Canada still has about 100 basis points worth of cuts this year.
100 basis points of cuts this year. Does it continue cutting in 2026 in your view?
Right now, we have them stopping their cuts at the end of the year, towards the end of the year. So we don't have at this time cuts in 2026, and really that's the what changes from what you would expect in a significant shock like this one, which could what could potentially be a very significant shock. If we have a U.S. recession, normally you would see both the Fed and the Bank of Canada bring rates to perhaps their lower bound. That's what we've seen in the price cycles and after the pandemic. Now we're not expecting that precisely for the reason that you have that inflationary component. And inflation expectations do matter, do influence. I mean, the Bank of Canada's own surveys reveal that businesses that are going to be affected by those tariffs intend to pass those in full to end consumers. So the Bank of Canada would be pretty foolish not to take those into consideration. So, the big story here is that the stimulus effort will disproportionately fall on the shoulders of governments, which is quite contrary to what we've seen in the past. More of that burden has been shouldered by the central banks, but I don't think we're in that world anymore.
Okay, so that sets up my last question. How much of a wild card, if at all, is the outcome of the upcoming federal election, where we will get either a Carney-led Liberal government or a Conservative government, and conceivably a minority government, although the polls seem to be pointing in majority Liberal territory. How much of a wild card is the outcome of the Canadian federal election?
I don't think it really will play a significant role in the grand scheme of things. What's the dominant factor really is what's happening in terms of those tariffs, in terms of the uncertainty that they cause, in terms of the decisions that we're hearing about every day in some key sectors of the economy. And really the next government's job will be not necessarily, I hear often how, this is an election about who can stand up to Donald Trump. That's to some extent, but really nobody can really control or try to guess what's in Trump's mind. So really the focus will be what's under our control. So how do we pivot this economy? Where do we invest? How do we invest, and how do we use the fiscal capacity, which fortunately we do have, but how do we use it in a way that stimulates growth and reduces our dependence on U.S. exports in this economy? Still 18% of our GDP consists of exports to the U.S. So really need to get that number down and take advantage of those alliances that we have with other countries. I think that's going to be really the medium and long-term strategic focus for the next government. But what's really happening in the here and now, I think to a great extent, the damage, unfortunately, is already done when you look at uncertainty and confidence in particular.
Jimmy, thank you very much for a great conversation. Jimmy Jean, Vice President and Chief Economist and Strategist at Desjardins.